Thanks, Gordy, and good morning. Our underlying profit of 85 mil is an increase of 11% on last year, with the big driver being resale gains, which were up 55%, and management fees, which lifted 24%. We had a satisfactory lift in our reported profit, up 8% to 203 million. This was on the back of good trading and valuation gains of 118 million. The valuation was up, firstly, because our valuers lifted our 5-year plus long-term growth rates from 2.8% to 3.4%. This compares to the long-term average actual house price increase of 6.5% since 1992. So we would view this as conservative. In the short term, the growth rates reflect a flattening housing market with an average of 1.9% per annum over the next 4 years. Secondly, we added 137 new units to the valuation. And finally, prices lifted 4%, reflecting strong demand for our village offering. Resales have been a big driver of earnings this half. The resales bank of gains still to come increased slightly to 770 million. These pent-up gains mean we can expect our resale earnings to keep on going, even if the housing market was flat for several years, because volumes increase as villages mature. Deferred management fees also reset to new price levels with each resale, creating a compound effect. Strong resale earnings are also a function of growing demand, with volumes increasing 12%. Only 46 units, or less than 1% of our portfolio, were available for resale at the end of September. Care demand was very high as well, and we averaged occupancy at 97%. The aged care sector in general is averaging around 87%, so we are significantly outperforming the market. We have a very strong financial position with total assets of 5.3 billion, and shareholder equity has lifted significantly to 23%, by 23% to 1.8 billion. Our debt has increased to 945 million as we continue to grow both the land bank and invest in new villages due to open in 2018. Our debt to debt plus equity ratio is 34%, which is consistent with prior halves, so our debt is growing in line with our balance sheet. We regard it as productive debt. We invest the bulk of it in new villages where we recycle capital, which establishes a growing tail of recurring cash flows. We continue to have very supportive banking partners, and we have recently added the Bank of Tokyo Mitsubishi to our syndicate. Our total bank facility is now $1.25 billion, which means we have over 300 million of bank headroom. Our development margin for the half was 17%, which is lower than our target range of 20 to 25%. This is a direct result of Bob Scott and Petone, which we had previously advised as a lower margin site due to the seismic requirements. Excluding Bob Scott, our development margin would have been 20%. For the full year, we're expecting our margin to be within the target range. Affordability of our units is something we monitor very closely. This chart shows you what I mean. Our residents in Auckland and Melbourne free up significant amounts of capital when they move into a Ryman village, so there remains plenty of price headroom for incoming residents. With 14 new villages in the pipeline and a large resales bank, we can expect the capital sums at our villages to more than double over the next 5 years. This will grow from $2.6 billion today to over $5.4 billion. This growth reflects not only a ramp-up in Melbourne, but also the economic benefit of building in higher value locations. A significantly larger capital base lays the foundations for much bigger recurring cash flows from both resales and DMF in the future. On top of this, we get increased care earnings from building more aged care beds, or as David described it earlier, each village creates a new economic engine to power the growth of the company. What triggers our ability to grow in this way is simple. It's our business model of recycling capital at each village. Since listing in 1999 and raising $25 million, we have now invested $2.8 billion and paid out a growing dividend stream to shareholders of $630 million. But we've never had to raise any fresh capital. So the outlook for the full range is an underlying profit in the range of $195 million to $210 million. And before I hand back to David, I want to highlight to you that we have made some additional disclosures on resident average age, our debt composition, valuation assumptions, investing cash flows, and average tenure of vacated units within the appendices to our results presentation. Thank you very much, and over to David.